Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is Gargi Pal Chaudhary, Head of iShares Investment Strategy Americas at BlackRock, which we know is the world's largest money manager with $9.5 trillion in assets under management. We're talking about the mid-year 2021 outlook and ETF strategies for the second half. Gargi, welcome. Great to have you on the show.
Hi, Nina. Thank you so much. It's great to be here.
So I wanted to start with the first half market performance, and it was really good. The S&P 500 gained 14.4%, which was its best half-year performance since 1998. The Dow Jones rose 12.7% and the Nasdaq jumped 12.5% during this period. And the small cap Russell 2000 index was the best performer with a gain of about 17%. Looking at the sector, energy and financials were the top performing sectors. So let us know your thoughts on the first half market performance.
Sure, Nina. As you pointed out, obviously a tremendous start to risk performance in the first 6 months of the year. And it makes sense, with our 2020 vision and looking back, we had this powerful economic restart. And when we think back to just November of 2020, before we got the vaccine, and sitting today with about 60% of the population in the US having received their vaccine, that played a huge role. Along with that, I would also say that the fiscal stimulus that came along all of 2020, but also the additional stimulus that came along in March of 2021, obviously had a huge factor in terms of consumption and demand from consumers that played a part in the recovery in the stock market that we saw in the first half of 2021. And the other thing that I would say is pretty remarkable is the amount of cash on the sidelines. So despite all of the performance numbers that you laid out in the beginning, there is still, look at money market mutual fund flows, which I'm sure you do, there is still a tremendous amount of cash that's sitting on the sidelines. So it's definitely been a fiscally stimulated, monetary policy supported, vaccine-led first half of the year with a powerful economic restart. And just thinking about ETFs more broadly, I would say that powerful restart did lead to a huge amount of flows into sort of the cyclical sectors of the market. So just looking at cyclical sector ETFs, they outperformed defensive sectors by about 53 billion in the first half. Again, tying into that economic restart theme.
Yeah, very interesting first half for sure. And now the second quarter earnings season has started. Big banks are leading the parade this week, and expectations are very lofty. And we had strong earnings in the first quarter as well. Second quarter earnings growth is expected to be over 60% year over year, which would be the highest increase since the financial crisis. But some experts say that this could be the peak earnings growth for the S&P 500. And talking about economic growth, we have seen that some of the recent economic reports suggest a weakening economy, and that has mainly been responsible for the recent drop in treasury yields. So what can investors expect from the second half of 2021 in terms of economic and earnings growth?
Sure thing. So a lot to unpack there. You laid out that obviously there are some expectations that earnings growth can slow down. And remember, a lot of this is year-over-year changes. So when we're looking at calendar effects and obviously knowing the second quarter that we had in 2020, depending on sort of, how the particular sectors did in the previous second quarter of 2020, obviously hard to get some of those numbers to match up. But we pivot a little bit towards thinking about economic growth. And you made an interesting point there around economic data slowing down, which as you said, your view was that is what led to bonds actually rallying, especially in the second quarter. And I would say that actually the economic data has been really robust. If we've seen any kind of a weaker than expected, especially on the labor market front, that has been very much around a supply related issue. So to your point, however, can we start to see a little bit of a softening in the third quarter? Possibly. I think that as we get a plateauing of the vaccination counts and the sort of consumer-led restart, we think of the restart, if you will, as turning on the lights. That can only happen once. So we can all go back to enjoying the services economy, but we're doing it once. So even if we go back to eating at restaurants, you're only doing that once a night. You can't do that 8 times a night. So there will be a little bit of a plateauing, but by no means is that falling off a cliff. So for the full year of 2021, the full year growth picture still looks extremely robust. We expect that to look somewhere north of 6%. So much, much above the potential growth of the country, which, as you know, is about 1.8 to 2%. So still remaining at a very robust pace, but there could be some slowing in the pace of growth when we look at third quarter, and that should just be viewed more a slowing down or a plateauing rather than a falling off a cliff.
So one of the biggest concerns for investors has been inflation, and particularly whether the recent pickup in inflation is transitory, related to pandemic-driven factors, supply chains disruptions, and all that you also mentioned and alluded to, or this is the start of a longer-term trend. Now, yesterday's CPI report was much harder than expected, but today the Fed Chair, Jerome Powell, reiterated that inflation is mostly due to temporary factors, and he said that economy needs to improve more before the central bank will change its ultra accommodative monetary policy. And we have also seen rising number of virus infections lately, despite very good vaccination rates. And that is mainly due to the spread of this deadly Delta variant. So in your view, what are the biggest risks to the current stock market rally? Is it a surge in inflation or higher interest rate or a possible central bank policy error? Some experts say that the Fed may be behind the curve. Or is it the COVID-19 variants or anything else?
Sure. I'll actually, before I answer that, I'll just spend a minute on your inflation question, because I do think that's probably the biggest driver of markets, or how you want to position in markets for the second half of the year. And our view is actually, and we lay this out in our mid-year implementation guide that was out on July 8th, that our view is that inflation will actually be a little bit higher than we've seen it over the past decade. So, of course, there are a couple of drivers of inflation that are definitely for transitory reasons, related to sort of demand-supply imbalance, especially as it comes to the semiconductor sector and the chip shortage in the auto manufacturing sector. And we saw that in yesterday's CPI prices. We saw that in car prices yesterday. But broader than that, there is a story of inflation staying higher than it's previously been, sort of staying at the perhaps 2.5% to 3% level for a longer period of time. And that is something that is going to drive certain sectors of the market. So next, as we think forward to the second half of the year, sort of transitioning your portfolio to areas of this equity market that will do well when inflation picks up. So looking at energy equities, looking at financials, these are areas of the market that tend to do well when inflation is, not at 7, 8, 9%, but at a modestly higher. And again, that's where we think inflation will run. So with that backdrop, I'll actually come to your question, which was around what are some of the risks that we see? And, there are a few to think about here. Obviously, you bring up one, which is around the Delta variant risk. And we all have to be humble around that. This is a new virus, and we have to be respectful of the ways in which it can mutate. And obviously, we saw that. I'm from India, and I saw that in my home country, and the devastation that took place in India as a result of the Delta variant. And of course, we're seeing pickup in cases in the UK, and that's been a concern. I would say the one thing that gives me a little bit of comfort, however, is obviously in the US, given the vaccination rates are as high as they are, obviously the transmission, especially to hospitalization and deaths, seem to be a lot lower. So that does give me a little bit of comfort, but certainly something that is very much on our radar. I would also say another view around just what could investors be thinking about as it comes to risk, in addition to the Delta variant and somewhat higher inflation, which of course you can hedge for, is it's also around geopolitical risks. I think this is something that is very much front and center of our minds at some times, and then we sort of move away and don't pay attention to it. We only pay attention to one thing at a time. So right now, no one's really talking about geopolitical risks because it's not the topic of the day. But just more recently, as we've seen some of the protests around Cuba and Brazil and sort of exacerbated levels of inequality that have come about as a result of the pandemic, I think some of that could bubble to the surface. And perhaps that is also something that could drive some volatility out in the near future.
Very interesting. And you talked about flows into cyclical areas of the market this year. And in fact, cyclical areas did very well earlier this year. Value ETFs did very well. The iShares Russell 1000 Value ETF was that significantly outperformed the growth ETF earlier this year. But lately, since the beginning of June, we have seen this resurgence in growthier areas of the market, particularly mega cap tech. So do you think the reflation trade is over now? And you talked about your thoughts on inflation. But what are your thoughts on the recent tech resurgence and growth resurgence, which we have seen since the beginning of June?
Sure. So to your point, there's obviously definitely been that resurgence towards the growthier sectors of the market. And as you know, that has followed the path of interest rates, the path of real interest rates, to be more precise. So in the first quarter of 2021, where interest rates moved higher, you saw that play out like a perfect playbook, where you saw the value outperformance. Our iShare VLUE, which is our value factor ETF, outperformed IVV, which is S&P, by about 7%. And I would say that going forward, to answer your question, is the reflation trade over? We actually think there is room to run for the reflation trade. Economic growth will remain historically high. We think the inflation transitory story is perhaps a little bit too played out. We actually think it's a little bit more than just transitory, and inflation will remain elevated over quarters, not months. And then in the longer term, given the Fed's average inflation targeting, we think that will push inflation to run higher than it has in the previous.
So yes, to your point, reflation trade did briefly run in front of the restart, and I think a part of it was that it became quite the consensus trade, and as a result of that, we saw a resurgence of growth. But I would say that we think, and we highlight this in our midyear guide, that there is a new nominal regime which is at play right now, which means that inflation will be higher in the medium term, and actually bond prices interest rates won't move as high as they have in the past. So with inflation running higher, we think that the cyclical-oriented stocks, value stocks, financials such as IYF, small cap stocks such as IJR that have historically benefited during periods of higher economic growth, during periods of inflation, still do have room to run. And part of this is also because our view is that interest rates right now are too low. Given the economic backdrop, given the inflation backdrop, we do expect nominal interest rates to move higher in the second half of this year. And, to a certain extent, we've begun to see that already, though not in as forceful of a way as we would expect.
So how should investors position their portfolios for the second half of the year? Should they focus more on cyclical areas that can benefit from this reflation trade? Should they look at stocks outside the US? Talk to us about some of the implementation ideas.
Absolutely. So a few things here. You bring up whether investors should be thinking about areas outside of the U.S. And let's answer that first. I think investors should be following the path of the vaccination progress. And the area that points to next is actually Europe. That is where vaccination progress has taken place tremendously well. In the first half of this year, the growth was very concentrated in the US. And we think that widens out in the second half of the year, and that favors allocation to European equities. And this is also not just a vaccination story. You also have an extremely accommodative central bank. You have the ECB that's likely to stay on hold, especially now with their new symmetric inflation target that they just announced. So we think in implementation, IEUR is the ETF that we suggest, which allocates towards European equities, makes sense. And at the same time, when you're looking at US markets, I think that tilt towards cyclical parts of the market, towards small cap, also continues to make sense, and towards sectors that I mentioned earlier, such as financials. The IYF ticker is one that we like. We believe will continue to offer value to a portfolio. And I'll also say that we spoke so far about the equity market, but there are ways to play this theme in other markets as well. And we think investors should do this in a multi-asset approach. And when we think about fixed income, of course, I mentioned earlier that we think yields will go up, but you still can get protection, especially if you think inflation is going to move up, which is our view. And one of the tickers that we recommend actually is STIB, which gives you inflation protection, but also a very short duration. So that's another area of the market we think can continue to do well, as it already has for the first half of the year. And finally, I think commodities is another area that we think will have many beneficiaries to it for several reasons. First, obviously, the global demand, which will keep some of the sort of traditional energy sources doing well, traditional commodities doing well. But also there's a transition to a greener economy. And this transition to a greener economy, to a decarbonized world, will be really beneficial to certain commodities, especially those that help in an electrification process. So really think about copper, think about lithium. So we also think investors should think about a diversified view into commodities, and COMT is one of the tickers that we recommend investors look at, and that's had a tremendous amount of inflows for the first half of the year.
Some very interesting ideas, and Europe is in particular very interesting because US investors are very much underweight international stocks, because US stocks have outperformed international stocks over the past decade. And lately there have been concerns about the spread of the Delta variant in Europe, and of course in most of the developing world too, particularly in India. But vaccination rates are picking up. So looking at Europe makes a lot of sense. You talked about transition to green energy, clean energy, and I wanted to talk a little bit more about clean energy ETFs, which were among the best performing areas of the ETF market in 2019 and 2020. They have taken a hit this year. But they continue to get a lot of flows because investors are still they are interested in that theme. And in general, we have seen a lot of flows into ESG ETFs because of investor preference for sustainable solutions, sustainable investments. So do you think clean energy ETFs can rebound in 2021, and also your thoughts on ESG investing in general. Please also talk about some implementation ideas.
Sure, absolutely. And I think this is the crux of how investors will change behavior and change investments over not just the remainder of this year, but I would say over the remainder of this decade. And to your point, I mean, sustainable flows have picked up meaningfully in 2021, especially when we think about where we were just 3 years ago. And if we think about, 2021 and all of the countries across the world and all of the companies across the world that have signed up for reaching a net zero world by 2050, what do we think that needs? To reach this net zero emission by mid-century, annual clean energy investment will need to more than triple by 2030. And that number is going to be somewhere around 4 trillion, we think. So that itself represents such a huge investment opportunities, especially for companies that focus on clean energy technology. Our iShares Global Clean Energy Fund, which is ICLN, does help give access to these type of companies. It's had seen tremendous inflows year to date. And yes, to your point, there, you pointed out that there has been some underperformance this year. But if we think about 2020, there's, it was a very impressive, about 142% return. So I think there has been a little bit of a give back. And I think that the clean energy trade is one for the longer term. This isn't just, will this work in August? Will this work in September? We think it'll work in the long term, as we talked about, when all of this investment will go into making a sort of a decarbonized world by the middle of this century. So I think that's something that investors definitely have to keep in the forefront of their allocations, and think about ways that they can access this market. And here at within iShares, we're offering investors different ways to access what, how they want to approach ESG. So if you want something that is very specific, such as clean energies, ICLN we talked about, we have that available for you. But it's not a one size fit all. So some investors may want something that is a low carbon transition, and we have an iShare that we make available for our clients for that. Or you might want a broader index, which captures a broad market index, which is actually ESG friendly. So we have ESGE and ESGU and many other tickers that actually give you those broader market access in ESG friendly manner. And obviously there's other sort of more impact oriented areas of the market as well. So if you want to look at green bonds, for example, we have an ETF PGRN for that as well.
I also wanted to talk a little bit about the infrastructure related ETFs, because we have seen some very positive developments on President Biden's infrastructure plan, which is basically aimed at improving the country's transportation, water, broadband, all those areas of infrastructure. So talk to us about the plan and the ETFs that could benefit from that plan.
Absolutely. So we just had the most recently announced $1.2 trillion, the Bipartisan infrastructure plan, and that's going to make historic investments towards revitalizing as well as rehabilitating U.S. infrastructure, right? So this is new infrastructure as well as improving existing infrastructure. So when we look at some of within that 1.2 trillion, we see that there's about 579 billion, which is the new funding. And some of that is going to go towards sort of, I look at the breakdown, roads and bridges, about 109 billion, power infrastructure is about 73 billion, but there's also environmental remediation. There's also EV infrastructure and electric transit. So there isn't just sort of the more traditional forms, the more traditional sort of roads and bridges infrastructure. There's also the EV side of it. So more the physical as well as the digital infrastructure. And this is a trend we think that will be, again, with us for the medium term, if not the long term. So again, this is something that, investors are moving towards IFRA, which is our infrastructure ETF, and that's the flow there has started from the beginning of the year. But I think that that's something that's going to continue for some time, because this isn't just a playing for higher inflation via infrastructure story. This is really thinking about the next 8 years, the 1.2 trillion proposal that is going to be now spent over the next 8 years. That is an investment of about 150 billion a year and double what was being spent, frankly, in the last year. So a huge opportunity. We're already seeing that inflow, with inflows into our IFRA fund. And we think that there's other ways to play this as well. So you do want that traditional sort of infrastructure operators, such as railroad operators, as well as more of the enablers, such as cement producers. You do want that traditional. But we also think that this could be more for digital assets, such as EV, such as cloud. Semiconductor ETF, I would say, is another way to sort of play this, and SOXX is the way that we would do it with iShares. It's the backbone of these powerful emerging technologies that are so integral to this, allowing us to get to some of these electric vehicle charging stations, etc., self-driven cars. So overall, it's a really important theme. And infrastructure can be played in a few different ways. And IFRA, obviously more traditional, but there's sort of many other ways to play it as well, such as sort of going towards IDRV or SOXS.
Excellent stuff. That's all we have time for today. Gargi, thanks so much for joining us.
Thank you, Nina. It was great to be here.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@sachs.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.